How to make 50% returns with options. In today's video, we're gonna explore this strategy. Basically, the way it's going to work is we're gonna start with buying 100 shares of a certain stock. In this case, I'm gonna be showing you this example with Mara. Mara is a Bitcoin mining company. It is highly volatile, which means that we can get a lot of intrinsic value when selling options. Okay, so the first step will be to buy 100 shares of the stock. Okay, the cost of this is going to be $1,838. Like I said, Mara is currently trading at approximately $18.38 per share. Then we're going to go 1 year out, and the reason why is that I want to get annual returns. This is an annual return of 50% is what I'm looking for. So I'm going to the calls expiring on January 2026. And I'm going to be looking at the deep in the money calls. And the reason for that is because I want to sell these calls. I want to get the extrinsic value of these call options. And I want to secure the probability of being assigned on these calls. So in other words, I want to be assigned. It's different to what most people want to do with options. When they sell options, they don't want to be assigned, but in this case, that is what we're looking for. Okay, so just as an example, let's say we choose these $8 strike call options. So what I'm gonna do is I'm going to sell the $8 strike call. For that, I'm going to get currently $1,303. So $1,303. And so basically, what happens is I invested $838. I'm getting $1,303 now. This is my investment. This is what I'm getting now. And then when the call option gets assigned a year from now, I'm going to be getting $800. And so let's calculate what the profit is going to be on that. Let's say I initially invested that amount, and now I receive that amount when selling the call, and I will receive that amount when getting assigned on the call. So that's going to be a profit of $265. Again, this is the money I invested in purchasing 100 shares. This is the money I get for selling the call now. And this is the money I'm going to get for being assigned on the call in the future. Okay, so all in all, what this investment might look like is something like this. You have a profit of $265 and you have invested $1,838. So let's see how much of a return that is. Basically, we have 265 divided 1838. That's going to be approximately a 14% return on your money. Now, for most people, this might seem pretty good, but actually it is better than this. Let me show you what's truly happening here. Whenever you sell a call, you are already getting cash. In this case, we're getting $1,303. This cash is money that you can either spend, money that you can reinvest, or even money that can just earn interest on your account. It is money that is not tied up to the investment, so to speak. So what is your true return and what is the true capital that you are tying in the investment? Well, the capital that is being tied to this investment is the 1838 minus 1303. In this case, that is, let's calculate that, 1838 minus 1303, $535. That is the capital that is actually being tied to this investment. And so if we now get the profit of 265 and we calculate the return using that capital, 535 times 100, it's going to look something like this. 265 divided by 535 times 100, it is 49.5% return. And this is why I'm saying that this is a way to get 50% annual return with using options. Now, before you say that this is too good to be true, obviously there are some risks associated to this. But the risk is that we are going a year out and the shares of MARA are trading at lower than $8. Remember, we want to get a sign on this goal. We want to get the $800 because in that $800, there is this profit of $265. In that $800, there is that $535 worth of capital that were tied into this investment. So you either are going to get 49.5% on your investment if the shares of MARA are trading at $8 or above, or if they're trading at less than $8, well, you basically are buying shares at a lower price at that point. So let's see some situations of what it's going to look like if the price of MARA drops. Where basically, right now you are having $535 tied to the investment. So how much will the price of the share have to drop for you to break even? Well, currently they're trading at 18.38 minus 5.35. That is a drop in price of, that would be 1303. So 1303 represents a, let's see how much is that on a percentage basis. 1303 divided 18.38. That is approximately 70% drop in price. So in other words, MARA will have to drop 70% within the course of a year in order for you to just break even in this investment. Obviously, it can drop to a lower price than that, meaning that you can keep the shares and keep trading options on it. However, you're looking at two scenarios. Either MARA drops to approximately $5.35, which means a 70% drop in price, and you break even, or MARA continue trading at a price higher than $8 within a year from now, and you make 49.5% on your investment. So that's it. In a nutshell, you are tying up capital that is a lot lower of what the initial investment requires. And the lower you go on the strike price, the more you're securing the probability of getting a sign on that call a year from now, and you're able to get all your money back plus the profit. All right, so that's it pretty much for this strategy. Let me know what your thoughts are. I think that this is a very interesting strategy for you to be able to get on a stock at a very low price. In this case, we are securing a cost basis of $5.35 if you want to keep the shares as a long-term investment, or we are securing making a 49.5% return on our investment. Thank you so much for watching, and I will see you on the next one.